I am Rohan Sharma, your mentor in this program. Today we discuss fixed income products. In the last lecture, we discussed that why we need an investment in fixed income instruments. So this lecture will provide you the different varieties of fixed income instruments that an investor can look for. So there are so many fixed income instruments like bank term deposits, company fixed deposits, post office time deposits, recurring deposits, sweep in fixed deposits, debt mutual funds, commercial papers and T-bills are the major part of fixed income instruments. So we discuss each of the part in a detail. The first product that we discuss in detail is bank term deposit. A bank term deposit is a safe choice for short-term investments. The term deposit of a various banks start from 7 days to 14 days, 30 days, 45 days or even up to 10 years of time. That means a term deposit will offer you short-term to a very long-term strategy. Such deposit even can be renewed on maturities and hence funds can be reinvested if the need is not there. So if I don't require that money will be reinvested or renewed in a easy or a simple manner. Under the deposit insurance credit guarantee scheme, each depositor in a bank is insured up to a maximum of 1 lakh rupees for both principal as well as interest amount. So up to 1 lakh rupees, the guarantee is given by DIC GC, which said that if the bank is default and not able to pay the fixed deposit amount, then DIGCA will give you 1 lakh rupees a deposit as an insurance amount to you. Most of the banks allow you to invest FD in an online mode also. You can take the fixed deposit through mobile banking, net banking, online, or you can personally visit to the branch. In every fixed income instrument, we have to discuss the 4 purposes for which the instrument is made for is tenure, liquidity, returns and the taxation purpose. In all 4 criteria, we have to understand the available investment product in detail. So let's discuss this all 4 criteria in detail for bank term deposit. As the table show on your screen, you first see the tenure. We already discussed the term deposit comes with a various tenure, start from 7 days to ranging to 10 years. The liquidity premature is not allowed, but small time maturities can help you for your more liquid assets. So if I want to get a premature less than a month, then we already take the 7 days term deposit, so that can be renewed after 7 days in a simple fashion. The returns may be opt for monthly, quarterly, half yearly or yearly cumulative interest option in them. The taxation will be, the interest income will be taxed as per the income slab. TDS is applicable if the interest amount is more than 10,000 rupees of interest earned. If in a whole year, if the interest amount is less than 10,000, then there is no tax deducted source. If your interest income is more than 10,000 in a year, then the tax deducted source will be applicable. Now we discuss the company fixed deposit in details. The company fixed deposits are unsecured deposits and therefore carry a very high risk. In case of a default, the depositors have the last right to company asset. The company asset will be auctioned and the amount which is recovered from it will be given to the depositors. Both manufacturing companies and the non-banking financial companies issue such kind of deposits. The interest rate of this deposit are maybe 1 or 2% higher than the bank fixed deposit, but the risk of losing of the entire principal and the interest amount is very high, even if the deposit carry a high interest ratings. So before considering the company fixed deposit, we have to tackle with risk. The risk tolerance or the risk avoidance will be considered by taking care of credit ratings and the past historical payment history of these companies. If we consider this company fixed deposit into our 4 criteria, then the tenure will be exactly 1 year or minimum tenure. Liquidity will be premature exit is allowed as the company discretion to honor it. If the company is not honor it, you can't do anything. Then premature is not allowed. Returns are much more lucrative. It is 1 or 2% more than the bank fixed deposits. And the taxation is as per the income slab. TDS is applicable if you earn 5,000 or more of the interest amount, then the TDS will be charged from the company end. Now we discuss recurring deposit in detail. If one want to save regularly for a shorter period of time, say for 6 months or 9 months or 12 months, a bank will offer you a recurring deposit product. RD, that is a short form of recurring deposit, invest at regular interval for a fixed period, and on the maturity you will receive a lump sum amount. Most bank will allow investing in RDs online. You can use the ECS, electronic clearing system facility, that will automatically debit your amount from your bank account, and that will be deposited into recurring deposits. If we measure the recurring deposit in our 4 criteria, recurring deposit is used for a tenure of low as 6 months, and that can be in a multiple of 3 months up to 10 years. Liquidity for the recurring deposit is lock-in period of 1 month. Returns are applicable as same as bank fixed deposits, and taxation will be similar like bank fixed deposit. It is taxed as per the income slab, and the TDS will be applicable if the interest amount of more than 10,000 in a year, then the TDS will be deducted from the bank side. Now we discuss sweep in fixed deposits. For parking funds for a short-term time frame, one generally keep it into a saving bank account which offer a high liquidity, but the returns are very low. So for this solution, the sweep in FD will be work differently in the names of multiplier, or somebody is also called as 2-in-1 accounts. That means a saving account and the fixed deposit account will be clubbed in one account. That means once your fund is not in utilization, it will be sweep or automatically convert into fixed deposit. One may open the sweep in FD account by visiting the bank branch or through a simple net banking. So you can adopt the offline as well as the online mode for opening or applicable of sweep in FDs along with your saving bank accounts. In FDs, in 4 criteria, the tenure will be fixed tenure of 12 months. The liquidity will be RD as a minimum lock-in time of 1 month. Returns are similar to bank FDs, and taxation will be as per your income slab, and TDS will be applicable if you earn more than 10,000 of interest amount in a year. The major important part in sweep in FD is that tenure will be much more lesser than a day also, and the premature validity is not applicable on sweep in FDs. You can exit at any point of time. There is no penalty on interest will be taken in sweep in FDs. Now we can discuss debt mutual funds. There are majorly 4 categories for debt mutual funds. The first is liquid fund, where you can invest in debt and money market instrument with maturities and the underlying security is up to 91 days. Ultra short term funds that is offered by various debt mutual funds. Investment are made in debts and money market instrument where maturity of the underlying securities are between 3 months to 6 months. Then low duration funds, the security or the investment amount is invested in debt and money market instrument where the maturity of the underlying security is more than 6 months. Then we consider for the money market mutual funds where the maturity is up to 1 year. So all four funds are categorized into time frames. If we require 91 days secure maturities, then we use liquid funds. If we use a liquidity of 3 months to 6 months, then we can use ultra short term duration funds. If we want from 6 months to 1 year, then we can use low duration funds. And if you need a liquidity up to a year, then you can use money market funds. If we categorize or test into our four criteria, then the tenure of the debt mutual funds as low as from 91 days to 1 year. The liquidity is high in these funds and the units can be redeemed in quick time. Returns not assured because it is floating, it is depend on demand and supply and the risk involved in it. Taxation, the gains that are under 36 months of the holding are added to income slab, normal income slabs, and if the holding time is more than 36 months, then it is taxed as 20% post indexation. So after considering the inflation, the returns that is taxed by 20%. Now we discuss treasury bill in details. Treasury bills are basically an instrument for short term maturities less than 1 year, and it is basically a borrowing by the central government. At present, the T-bills are 91 days, 182 days, 364 days for a short term maturities. Auction of T-bills are always be conducted by Reserve Bank of India. T-bills are issued on discount rates to face values, while holder get the face value at the time of maturity. That means the 100 rupees T treasury bill will be issued at right now at 60. So today you will put 60 rupees and after a certain period of time on maturity you will got 100 rupees. When the liquidity position in the economy is tight, the returns are higher or vice versa. So the returns will always be depend on demand and supply. Individual firms, trust, institutions, bank can purchase treasury bills. Commercial and cooperative banks use the treasury bills for maintaining their statutory liquid ratio requirements. If we measure the criteria, then tenure will be start from 14 days to 364 days. The liquidity is much more higher. The returns are depending on every day and change on every day, and the taxation will be short term capital gain. As the investment is holding less than a year, then it is considered to be short term capital gain will be applicable as per the slab rates on you. Now we discuss commercial papers. Commercial paper are usually issued at high value. It is unsecured money market instrument in the form of a promissory note and transferable between primary dealers and the all financial institutions. Individuals, banking companies, other corporate bodies and unincorporated bodies, NRIs, foreign institutional investors can invest in commercial papers. Financial institutions issue commercial papers, which is an unsecured promissory note, to raise fund for a shorter period of time, which is vary from 7 days to 364 days. So financial institutions, if we require for short-term liquidity, he can issue an unsecured promissory note in the form of commercial papers, and the maturity is varying from 7 days to 364 days. Test The commercial paper on all our 4 criterias. The tenure will be start from 7 days to 364 days. The liquidity is high in commercial papers because it is an overnight market. The returns will be 6.5% to 10% depending upon the demand and the supply, and the taxation will be taxed as per your income slab. So I hope so you enjoy the fixed income instrument products and you consider or enjoy or understand the fixed income instrument products. We conclude this lecture by giving you 3 major points. The first important point, you have to look for the liquidity as well as the returns for adopting any of the fixed income instrument. The second thing is you have to consider the risk involved in it of the default or interest. And the third important thing is the tax efficiency, how much tax will be applicable while investing in any of the fixed income